All right, in this lesson, we're going to be talking about the basics of depreciation. We're going to give you a foundation on which we are going to build the depreciation calcs on. So we're going to talk a little bit about the key terms that you're going to need to know. We're going to help you understand the theory of depreciation and then the different methods to how we calculate depreciation. So this is going to give you that foundation. And then from here, we're going to build upon that, especially when we get to the next few lessons where we're actually calculating depreciation. So let's talk a little bit about the basics of depreciation. So depreciation is the systematic allocation of capitalized costs over the useful life of the asset. And there's a couple of words here that I want to direct ourselves to. The first one here is capitalized cost. So up until now, we've been talking about the capitalized cost, the cost that we capitalize to the asset instead of expensing them. And then we are going to find a way to allocate them over the useful life of the asset. So that's what we're doing here. Now, the key kind of definition, key word in this definition is the systematic allocation. And what we're saying about that is that we're not just randomly picking numbers that we're going to expense every period, but we have a process, we have a calculation, we have a way that we're going to allocate it in kind of a fair way using one of the depreciation methods that we're going to talk about at the end of this lesson. So systematic allocation, it's just not wheelie-dealy, hey, we're going to expense this much this year, this much next year, and this much in the year after that. We actually have a process and a calculation to getting to that number. So for instance, let's say we buy a car and that car costs us $30,000 and that car lasts us for 5 years. So notice that I have a car here, $30,000, and I've got a timeline with 5 kind of different periods. So basically, when we talk about systematic allocation, it's like we're going to take this $30,000 and we're going to spread it, the cost, over 5 periods. So when we spread it over 5 periods, 30,000 divided by 5 is $6,000. So every year we're going to expense $6,000 in a systematic approach. No one period gets more than the other. No period is calculated differently. Now, this is not the only way of doing it. We could have different amounts in different periods, which we'll talk about in future lessons. But this is kind of the systematic allocation approach. We are systematically taking this $30,000 and allocating it over time. So $6,000 a period. Now, in depreciation, there's 2 accounts that you kind of have to understand. These are 2 new accounts maybe for you. And these are the basis on how we make depreciation entries. The first account that we are learning is the depreciation expense. This is the actual expense that we're going to be hitting when we allocate that $6,000 to each period. We are also going to learn something called the accumulated depreciation. The accumulated depreciation is the account in which we offset that depreciation expense. So we're not going to reduce the asset's cost that is in our balance sheet. Instead, we're going to use this account. So let's talk a little bit about this a little bit further here. Depreciation expense represents 1 period of allocated cost. This is an income statement account. It's an expense. So we'll hit the depreciation expense when we move $6,000 into our income statement for the year. Then our accumulated depreciation represents all of the depreciation taken on the asset since we first acquired the asset. This is a balance sheet account, and this is a contra asset. It contra assets to the actual long-lived asset that we are depreciating. So we'll talk more about that later on as we show you what it looks like on the balance sheet, but the accumulated depreciation is our offset to our depreciation expense. Now, the key thing about the accumulated depreciation is that it represents all of the depreciation we've taken on the asset since we first acquired the asset. So let me give you an example of how both of these would work. So let's bring back our car example here. So you notice that in year 1, we have $6,000 of depreciation expense. And so at the end of the year, we would book a depreciation expense of $6,000, and then we would offset that with an accumulated depreciation of $6,000. So our accumulated depreciation would be $6,000 in year 1. Then we go on to year 2. In year 2, we would have a depreciation expense of $6,000. But now that we have 2 periods of depreciation, the accumulated depreciation goes from $6,000 to $12,000. And then we keep going further. So in the third year, we would have $6,000 of depreciation expense. And since we've depreciated now 3 periods at $6,000, accumulated depreciation in year 3 goes to $18,000. And remember that, yeah, sure, we are hitting the depreciation expense account 3 times, but at the end of every year, it is a temporary account, and a temporary account we close at the end of the year. So this first $6,000, we're going to hit depreciation expense for $6,000, but at the same time, a few days later, when we close the books, we're going to close that depreciation expense because it's an expense account. So then depreciation expense goes to 0 as we move into year 2. And then we'll hit it for $6,000. And then again, it will close because we're at the end of the year. We have to close all of our books. So then that account closes to 0. So again, understanding that, sure, we're doing kind of the same things with depreciation expense and accumulated depreciation, but the depreciation expense closes every year. The accumulated depreciation doesn't close because it is a contra asset. So accumulated depreciation reports all of the depreciation we've taken since we first acquired the asset. So in year 3, we've depreciated the asset $18,000. So our accumulated depreciation balance would be $18,000 at the end of the period. So that's kind of how depreciation expense and accumulated depreciation will look like in our example with our car. Now, how would they be reported? On the financial statement. So on the income statement, I have a partial income statement here. Depreciation is an expense, depreciation expense is an expense. So you'll see that here on the income statement. It will reduce our net profit by that depreciation expense for that year. And then on the balance sheet, the way that it would be reported is we've got the asset here, the long-lived asset, the equipment. We have its cost, so we're just going to assume that the cost was $2,000. And then right below it, we have its contra asset, which is accumulated depreciation. That offsets the equipment, so that offsets that $2,000. So in this case, we're saying that the accumulated depreciation happens to be $500. So $2,000 minus $500 gives us a net book value for that asset of $1,500. So book value would be how much the asset is worth in our books. So the way that we get to that is we use the asset's cost or capitalized cost. We subtract its accumulated depreciation, which is all the depreciation we've taken since we first acquired the asset, and that would give us a balance. That balance then is the book value of the asset, what it's worth in our books. This is not fair value. Fair value is what I could sell that asset in the market. And 9 times out of 10, those two numbers will be different. So in our books, this equipment is worth $1,500, but maybe in real life, if we sold the equipment, it's actually worth $1,200. So it's actually worth lower than it is on the book, which is usually the case because we want to depreciate in a systematic way. But that newness to the usedness, that difference right there is usually very much huge. Just like when you drive a new car off the lot, it loses 20% of its value almost immediately. So that's the book value of an asset. The asset's capitalized cost minus the accumulated depreciation since we first acquired it would give us book value. So that is what it would look like on our financial statements. Now, we can then kind of think about how do we depreciate? Well, we calculate depreciation using 3 items, and we won't use them all the time, but we need 3 items in order to depreciate any item from our book. So the 3 things would be the assets cost, which is the initial capitalized cost, which we kind of calculated in the previous couple of lessons. Then we would need the useful life to the purchaser. The key thing here is this is not the asset's life. This is the useful life of that asset to the purchaser. So for instance, a lot of companies may decide that they buy new cars for their businesses, and then after 5 years, they get rid of those cars. And the reason being is that As the car ages, it has more repairs expense. The reliability goes down. Maybe it's not as efficient. So the company might believe that it's just better to use it for 5 years, get rid of it, buy a new one, have no problems, use it for 5 years, and get rid of it. And a lot of companies do that because they don't want to have to deal with all the repair expenses as well as the downtime for having the vehicle back in the shop. So, does that mean that the car after 5 years is not usable? Well, most people would say no. After 5 years, it could go for another 5-10 years before we actually have to scrap it. So notice that for the company, the useful life of that car is 5 years, but the actual asset life might be 10-15 years. Here, when we say useful life, we're asking what is the useful life in the eyes of the purchaser. In this case, it's 5 years, even though that asset might last longer than 5 years. Okay, so useful life to the purchaser, not the asset's life. The last thing that we need is the residual value. The residual value is when we decide to dispose of it, what could we get for it? So in our example of this car that lasts 5 years, after 5 years, the company's probably going to sell it, and they might get, instead of $30,000, which is what they purchased it, they might get $5,000 for it after 5 years. So that residual value is $5,000. What we would get for that asset when we dispose of it at the end of its useful life. Now, these are all estimates, which is okay, but we're going to do our very best to estimate the residual value and the useful life. Now, in financial accounting, principles of accounting, we're going to give you that information. We're not going to ask you to calculate useful life and residual value, so that's going to be given to you, but it's important to know that useful life is useful life to the purchaser, and then the residual value is what it's worth in the marketplace when we get rid of it at the end of its useful life. Now, depending on what method we use, we may need all three of these items to calculate depreciation, or we may not need them initially. Okay, so those are the three things that we're looking for in every problem to calculate depreciation. Now, there's something called the depreciable cost. So now that we have this, we have something called the depreciable cost, which is the actual amount that we are going to depreciate over the useful life of the asset. So to calculate the depreciable cost, we are going to take the asset's initial cost or initial capitalized cost. We're going to subtract it from residual value, which is what we would get once we dispose of it. And that's going to give us our depreciable cost. Now, you might hear throughout your studies that you need depreciable cost. Well, depreciable cost is actually the amount that we are going to depreciate over the useful life of the asset. So for instance, if our car costs us $30,000 and we expect to sell it for $5,000 when we are done with it, then our depreciable cost is $25,000. What that means is that we are going to depreciate the car $25,000 over 5 years. So when we make the depreciation every single year, we're going to be depreciating in total $25,000. Why not 30? Because we're going to recoup the $5,000 when we sell it in that final year. So depreciable cost is a term that you might hear and you might have to use. And so this is the formula for it. The asset cost minus the residual value will give you depreciable cost. Now, one of the kind of last things that we need to talk about is how do we depreciate? What are the systematic allocation approaches to depreciating? So when we we have three methods of systematically allocating costs over the useful life, which we'll be teaching you in the next few lessons. The first one here is the straight line basis. The second one is the units of production basis. And the last one is the declining basis. Now, I'm not going to explain it too much here because we're going to spend some time in a different lesson really talking about each one individually. But the straight line method uses an approach that was like the example that I gave you with the car with the $30,000, $6,000 a year. It's the same across every single year. The units of production is based on how many units that you might have produced or based on some type of cost driver. A cost driver is what makes the cost go up. So it could be miles, it could be number of units produced, it can be used, it could be machine hours. So some type of driver drives the cost or the usage of that asset, and that's what we're going to allocate the cost based on that cost driver. The last one here, the declining balance, assumes kind of this idea that the most useful part of an asset is at the very beginning of its life, and then it becomes less useful. So the declining balance would give a higher level depreciation in year one, and then it slows it down in the final year. So we take more up front and less at the end of its life. And so if we really want to think about it, straight line is also known as 100% depreciation, and then declining could be anything above 100%. So usually we'll see 150 or 200%. So 200% is we're going to take double what we would take from a straight line in that first year. So we're going to take twice as much, and then I'll show you how to calculate it to getting double declining throughout the rest of its period. So that's kind of how it looks like, is we've got our straight line and then our declining and then our units of production. So we will look at these three in more detail in the following lessons. So that's what we'll do there. All right, one last thing here, kind of the journal entry for depreciation, so that as we go in and talk about straight line, units production, declining method, you know how to journalize them, because that's one of the most important things that we do in order to update the books to the cost, or to the expense. So this is the journal entry for depreciation. We will debit depreciation expense, increasing the expense for the period, and then we will crediting the accumulated depreciation. So if you notice here, I would debit depreciation expense. So my T account here would look something like that. My accumulated depreciation, we would credit over here. And then notice I don't even touch the asset or the equipment. So if I was buying the car, I would have debited $30,000 here. And when I make the depreciation journal entry here, we do not touch the asset's value. We want to keep that asset value as consistent as possible, because it gives us reference to what that asset originally cost us. And if we understand the different methods like straight line, units production, or double declining, when I'm looking at the financial statement as a user, I can see how much depreciation we have left to go, which is important because depreciation is not a cash outflow expense, meaning that when I take the expense, the cash doesn't go out. The cash stays in the bank account. Okay, so that's very important from a cash flow standpoint. And so we want to know the difference between how much we've already taken versus how much we have taken and how much we have left. And by doing this, by not hitting this asset or this equipment, we ensure that we keep that cost intact until we finally dispose of it, or we write it down, which we'll talk about in another lesson. So that is the journal entry for depreciation. Depreciation expense, credit, accumulated depreciation. So that is a basis or basics of depreciation. I know it's kind of long, but we're covering all of the foundational knowledge that you kind of need to know going into our next couple of lessons. In our next couple of lessons, we're actually going to walk you through each different type of depreciation method, and we will start with the next lesson on straight line basis. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and I'll take you to that video. So until then, we'll see you in the next lesson.